Welcome back to Beyond the Benchmark. I'm Ryan Kasper. Economic data remained sparse last week as the U.S. government shutdown rolled into its second week, freezing key reports like CPI, retail sales, and industrial production. It's created a bit of a data blackout. Policymakers are flying blind until the government reopens. The September inflation report is now slated for October 24th, and once Washington gets moving again, we'll likely see a flood of delayed releases hitting all at once. That said, markets didn't wait around. Stocks rebounded after a rough patch, kicking off earnings season on a high note. The S&P 500 gained about 1.7%, the Nasdaq jumped over 2%, and small caps led with a 2.4% rally. Bonds also saw gains as yields drifted lower, and even commodities found a modest bid. Gold and other precious metals offset weakness in energy. The Fed made a little noise of its own. Chair Jerome Powell hinted that the central bank plans to slow the pace of quantitative tightening, CETA or QT, sometime in early 2026. That means the Fed will reduce how quickly it lets Treasury holdings roll off its balance sheet, slightly easing pressure on bond supply and potentially anchoring yields lower. It's not full-blown QE, but it's a step toward a more accommodative stance. Powell also reiterated that the Fed wants to gradually shift its balance sheet toward Treasuries only, phasing out its indirect exposure to the housing market through mortgage-backed securities. Meanwhile, manufacturing data was mixed. The Empire State Survey out of New York bounced back strongly into expansion territory, showing solid growth in new orders and shipments. But the Philadelphia Fed survey went the other way, plunging back into contraction. It's another reminder that the industrial economy remains uneven, especially without fresh government data to confirm the trend. On the corporate side, earnings season is off to a better-than-expected start. Roughly 12% of S&P 500 companies have reported so far, with blended earnings growth tracking near 8.5%. The so-called Magnificent Seven continue to pull the index higher, led again by Nvidia, but even the rest of the market is seeing growth around 7%, which is slightly above long-term averages. Internationally, Europe outperformed this week, while Japan and emerging markets lagged. A weaker dollar helped foreign assets, and cooling U.S.-China trade rhetoric added some optimism abroad. Bonds rallied globally alongside U.S. treasuries, and precious metals continued to attract buyers as geopolitical uncertainty lingers. So the big picture this week, the market shrugged off Washington gridlock and patchy data, leaning on dovish Fed hints and solid early earnings. The rally feels constructive, but keep in mind, without fresh economic data, we're essentially trading on sentiment, not substance. I'm Ryan Kasper. Thanks for tuning in to Beyond the Benchmark. Stay disciplined, stay informed, and we'll catch you next week.